On July 21, 2002, in a federal courtroom in Lower Manhattan, lawyers for one of the largest companies in America filed the biggest bankruptcy in United States history. The company had been worth $180 billion 3 years earlier. By the end of that summer, it would be worth nothing. I'm John. This is the Quiet Atlas. Today, how a Mississippi gym teacher built America's second largest telecom, how $11 billion went missing in plain sight, and how one internal auditor caught it. WorldCom started in 1983 as long-distance discount service in a coffee shop in Hattiesburg, Mississippi. 3 businessmen sketched the idea on a napkin. One of them was Bernie Ebbers. Ebbers had been a milkman, a bouncer, a basketball coach, and the owner of a chain of motels. He had no telecom background. What he had was an instinct for buying companies. Over the next 15 years, Ebbers used WorldCom's rising stock as currency to acquire more than 60 other telecoms. According to public filings, the strategy was simple. Every acquisition added customers, added revenue, and pushed the stock higher, which funded the next acquisition. The peak came in 1998. WorldCom announced it would buy MCI Communications for $37 billion. At the time, it was the largest corporate merger in American history. By 1999, WorldCom stock traded at $64 a share. Bernie Ebbers, the former gym teacher, was a paper billionaire. Then the telecom bust arrived. The dot-com bubble burst. Internet startups stopped buying bandwidth, and across the industry, revenue growth collapsed. Wall Street kept expecting WorldCom to grow at 20% a year. The underlying business was not growing at all. What Wall Street did not know was that Bernie Ebbers had personally borrowed more than $400 million from WorldCom, secured by his shares. As the stock fell, his loans became impossible to repay. According to court filings, beginning in the year 2000, Ebbers and his chief financial officer, Scott Sullivan, began directing the company's accounting department to do something the law does not allow. WorldCom paid other telecoms billions of dollars each quarter to carry calls across their lines. These were costs of doing business. Accounting rules required them to be recorded as operating expenses, hitting that quarter's profit. Sullivan had a different idea. He told the accounting team to reclassify these line costs as capital expenditures, as if they were investments in long-term equipment. Capital expenditures do not hit current quarter profit. Spread over many years, they barely move the number at all. The reclassification turned what would have been quarterly losses into quarterly profits. The stock stayed up. The bonuses kept paying. The fraud kept growing. By 2002, prosecutors would later say the manipulation totaled more than $3.8 billion in just 5 quarters. By the end of the unwinding, the total accounting irregularities exceeded $11 billion. Now I want to pause here, because in hindsight this sounds obvious. But for nearly 2 years, WorldCom's external auditor, the firm Arthur Andersen, signed off on these books. Wall Street analysts kept recommending the stock. Nobody outside a small group of insiders knew. The hard part of these stories isn't seeing them later, it's catching them while they're happening. The person who caught it was named Cynthia Cooper. She ran WorldCom's internal audit department, a team of about 24 people based in Jackson, Mississippi. In the spring of 2002, one of Cooper's auditors found a strange entry in the books, a capital expenditure of $500 million with no documentation, no supporting invoice, and no clear asset attached to it. According to her later congressional testimony, that was the thread she started pulling. Cooper's team began working nights and weekends in secret. The chief financial officer, Scott Sullivan, was their boss's boss. When Sullivan learned what they were investigating, he told them to stop. According to public filings, Cooper kept going. By June, her team had traced the manipulation across multiple quarters and found the pattern. Line costs that should have been expensed were instead capitalized. The numbers were not small. The numbers were everything. On June 25, 2002, WorldCom's board of directors announced that the company had improperly recorded $3.8 billion as capital expenditures over the previous 5 quarters. Scott Sullivan was fired the same day. WorldCom's stock, which had once traded at $64, fell to 9 cents. Within weeks, the company filed for bankruptcy. At $104 billion in assets, it was the largest bankruptcy in American history. Arthur Andersen, the auditor that had signed off on the books, was already in trouble. Earlier that same year, Andersen had been criminally convicted in the Enron case. The WorldCom collapse finished it. Andersen dissolved by the end of 2002. Bernie Ebbers, who had repeatedly told employees and analysts that he knew nothing about the accounting, was indicted by federal prosecutors in 2004. A note on what we know and how. The factual record about WorldCom comes from the SEC complaint filed in June 2002, from the trial transcripts in United States versus Ebbers in 2005, from the report of the bankruptcy examiner Dick Thornburg, and from Cynthia Cooper's 2008 book Extraordinary Circumstances. Most of what follows is from the public trial record. Ebbers' defense at trial was striking in its simplicity. He told the jury that he had not understood the accounting, that Scott Sullivan had run the numbers, and that he, Bernie Ebbers, was a non-financial CEO who trusted his finance team to follow the rules. Scott Sullivan had already pleaded guilty. As part of his plea deal, he took the stand against his former boss and testified that Ebbers had personally directed the manipulation quarter after quarter to make the numbers Wall Street expected. In March 2005, a federal jury in Manhattan convicted Bernie Ebbers on all 9 counts. The judge sentenced him to 25 years in federal prison. Scott Sullivan, who cooperated with prosecutors, received 5 years. Other senior accounting executives received shorter sentences. Cynthia Cooper, the auditor who started it, was named one of Time magazine's Persons of the Year for 2002. Bernie Ebbers entered federal prison in 2006 at 65 years old. He was released in late 2019 on compassionate grounds because his health had collapsed. He died at home in Mississippi 6 weeks later, in February 2020. What WorldCom and Wirecard have in common is not the fraud. Frauds happen in every industry, in every decade. What they share is the long stretch where the numbers looked fine, the auditors signed off, the analysts recommended the stock, and the few people who had questions were either ignored or actively pushed aside. The expensive part of these stories is the years before anyone caught them. Cynthia Cooper has said in lectures and in her book that the most important thing she did during those weeks in 2002 was keep going after she was told to stop. That sentence is older than WorldCom. It is older than accounting. It probably has not changed. That's the Quiet Atlas. If this helped, the playlist has more. See you next one.